Everything in London feels like it's getting more expensive, and water bills may eventually rise as well. One major reason is that Thames Water, the company supplying most of London and much of Thames Valley, is now under severe financial pressure, carrying one of the largest debt loads of any UK utility. Thames Water is the country's largest water and wastewater provider. It serves most of London and the wider commuter region, although some parts of the city are supplied by other companies. Because water is a geographic monopoly and customers cannot switch, the financial health of Thames Water matters enormously. To understand how the company reached this point, we need to go back. Thames Water was privatized in 1989 under Margaret Thatcher with virtually no debt. In 2001, it was bought by the German utility RWE, which later realized the business required too much investment and was too politically constrained and decided to sell. If you're curious about how large infrastructure assets are financed, structured, leveraged, and traded in global capital markets, make sure you follow this channel because the story of Thames Water is one of the clearest case studies of how those financial mechanisms work in the real world. The real turning point came in 2006 when the Australian investment group Macquarie acquired Thames Water. Macquarie fundamentally reshaped the balance sheet by adding two layers of leverage: acquisition debt at the holding company level and additional long-term borrowings at the operating company level through a structure called Whole-Business Securitisation. Under this model, the entire regulated business and its predictable monopoly cash flow supports long-dated bonds, allowing Thames Water to raise far more debt than a typical corporate utility could. During Macquarie's ownership, debt increased significantly and substantial distributions were paid to investors. Macquarie exited completely by 2017 with strong returns, but the leverage remained inside the business. After that, ownership passed to major institutional investors such as OMERS, USS, and Wren House. As environmental obligations grew and regulatory constraints tightened, many of these shareholders eventually wrote their equity down to zero. By 2024 and 2025, the capital structure had deteriorated to the point where lenders and bondholders, not equity owners, became the key economic decision makers. Thames Water explored a major recapitalization with KKR, but the process did not lead to a deal, largely because the balance sheet was already fundamentally unsustainable. And this is really the broader lesson. Infrastructure is ultimately a cost of capital story. High leverage can look efficient when interest rates are low, but when the cost of capital rises or long-term investment needs accelerate, a heavily indebted utility can become fragile very quickly. Thames Water shows how even a regulated monopoly with stable cash flows and guaranteed customers can run into serious trouble when its capital structure is pushed too far.